Chapter 6 Portfolio Policy for the Interpresenter Torvstave. Negative approach. Aggressive investors should start from the same base as the defensive investor, namely, a division of his funds between high-grade bonds and high-grade common stocks bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case, he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment, but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon. Here Graham has made a slip of the tongue. After insisting in Chapter 1 that the definition of an enterprising investor depends not on the amount of risk you seek, but the amount of work you are willing to put in, Graham falls back on the conventional notion that enterprising investors are more aggressive. The rest of the chapter, however, makes clear that Graham stands by his original definition. The great British economist John Maynard Keynes appears to have been the first to use the term enterprise as a synonym for analytical investment, issues, and much less for the lower coupons. He will let someone else buy foreign government bond issues, even though the yield may be attractive. He will also be wary of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere and make his choice between high-grade taxable issues, which can now be selected to yield about 7%, and good quality tax-free bonds, which yield up to 5.3% on longer maturities, seeking grade bonds and preferred stocks. Since in late 1971 it is possible to find first-rate corporate bonds to yield 7%, and even more, it would not make much sense to buy second-grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds at non-convertibles to the public in the past 2 years. Hence, their debt financing has been done by the sale of convertible bonds or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus, they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. High coupon issues are corporate bonds paying above average interest rates in today's markets, at least 8%, or preferred stocks paying large dividend yields 10 or more. If a company must pay high rates of interest in order to borrow money, that is a fundamental signal that it is risky. For more on high yield or junk bonds, see pp. 1 for 5, 1 for 7. Plus, as of early 2003, the equivalent yields are roughly 5.1% on high-grade corporate bonds and 4.7% on 20-year tax-free municipal bonds. To update these yields, see www.bondsonline.com/asp/news/composite/html or www.bloomberg.com/market/rates.html and www.bloomberg.com/. But even in the matter of price discounts and resultant chance of principal gain, the second-grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates 24 to 4% sold at about 50 cents on the dollar in 1970. Examples: American Telephone and Telegraph 2S, due 1986, sold at 51, Atchison, Topeka, and Santa Fe RR for seconds, due 1995, sold at 51, McGraw-Hill 3S, due 1992, sold at 50%. Hence, under conditions of late 1971, the enterprising investors can probably get from good-grade bonds selling at a large discount all that he should reasonably desire in the form of both income and chance of appreciation. Throughout this book, we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence, we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason, we shall reprint here our observations on that point made in the 1965 edition when high-grade bonds yielded only 4%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second-grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example: in early 1960 for Chicago, Milwaukee, Steady Paul, and Pacific 5% income debenture bonds at 68 yielded 7.35%. But the total interest charges of the road before income taxes were earned only 1.5 times in 1963, against our requirement of 5 times for a well-protected railroad issue. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full prices, that is, not many points under 100, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended or at least endangered, and frequently there is a pronounced price weakness even though the operating results are not at all bad. As a specific illustration of this characteristic of second-quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946-47. These comprise all of those which sold at 96 or more in 1946, their high prices averaging 100%. By the following year, the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946. Hence, the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than that in the common stocks in the Dow Jones Industrial List, about 23%. Obviously, the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25% against 2.5% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for the minor advantage in annual income, the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. The above example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue and carrying a correspondingly greater risk. It is bad business to accept in bond prices are quoted in percentages of par value or 100. A bond priced at 85 is selling at 85% of its principal value. A bond originally offered for $10,000, but now selling at 85 will cost $8,500. When bonds sell below 100, they are called discount bonds. Above 100, they become premium bonds. Acknowledge possibility of a loss of principal in exchange for a mere 1 or 2% of additional yearly income. If you are willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence, a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you are patient, you will probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. On the other hand, a large proportion recover their position when favorable conditions return, and these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues in the early 1940s as a consequence of the long depression of the 1930s. During the post-war boom period of 1945 to 1947, many of these large accumulations were paid off either in cash or in new securities, and the principal was often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. It may well be true that, in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrecoverable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well in the long run as one who limited himself to first-quality securities, or even somewhat better. But for practical purposes, the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their price declines precipitately. Furthermore, he cannot buy enough issues to assure an average result, nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds, or investors with even small experience know that foreign bonds, as a whole, have had a bad investment history since 1914. This was inevitable in the light of 2 world wars and an intervening world depression of unexampled depth. Yet every few years, market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomenon tells us a good deal about the working of the average investor's mind, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds such as those of Australia or Norway. But we do know that, if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba for as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 5s at 36, Greek 7 seconds at 30, and various issues of Poland as low as 7. How many readers have any idea of the repeated vicissitudes of the 8% bonds of Czechoslovakia since they were first offered in this country in 1922 at 96%? They advanced to 112 in 1928, declined to 67% in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered unbelievably to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago, an argument of sorts was made for the purchase of foreign bonds here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past, we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add now that the latter would benefit both his country and himself if he declined these opportunities. New issues generally, it might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly, there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issues, which means simply that these should be subjected to careful examination and unusually severe tests before they are purchased. There are 2 reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls therefore for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable for the seller and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. A tremendous amount of financing, consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons, was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions amply qualified to protect their interests. Hence, these offerings were carefully priced too. New issues of common stock initial public offerings, or IPOs, normally are sold with an underwriting discount, a built-in commission of 7%. By contrast, the buyer's commission on older shares of common stock typically ranges below 4%. Whenever Wall Street makes roughly twice as much for selling something new as it does for selling something old, the new will get the harder sell. Plus, recently, finance professors Owen Lamont of the University of Chicago and Paul Schultz of the University of Notre Dame have shown that corporators choose to offer new shares to the public when the stock market is near a peak. For technical discussion of these issues, see Lamont's Evaluating Value Weighting, Corporate Events and Market Timing, and Schultz's Pseudo-Market Timing and the Long-Run Performance of IPOs at http://papers.sseniorin.com. Meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer, but in the case of first-quality issues, the ill effects to the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the lower-grade bonds and preferred stocks sold during the 1945-46 and 1960-61 periods. Here, the effect of the selling effort is more apparent because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough, for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945-46 and again beginning in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962. After the usual swearing off period of several years, the whole tragicomedy was repeated step by step in 1967 to 1969. In the 2 years from June 1960 through May 1962, more than 850 companies sold their stock to the public for the first time, an average of more than one per day. In late 1967, the IPO market heated up again. In 1969, and Aston issuing 781 new stocks were born. That oversupply helped create the bear markets of 1969 and 1973 to 1974. In 1974, the IPO market was so dead that only 9 new stocks were created all year. 1975 saw only 14 stocks born. That undersupply, in turn, helped feed the bull market of the 1980s, when roughly 4,000 new stocks flooded the market, helping to trigger the over new common stock offerings. Following paragraphs are reproduced unchanged from the 1959 edition, with comment added. Common stock financing takes 2 different forms. In the case of companies already listed, additional shares are offered pro rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value. The sale of the new shares is almost always underwritten by one or more investment banking houses, but it is the general hope and expectation that all the new shares will be taken by the exercise of the subscription rights. Thus, the sale of additional common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interest to enable them to cash in on a favorable market and to diversify their enthusiasm that led to the 1987 crash. Then the cycle swung the other way again as IPOs dried up in 1988 to 1990. That shortage contributed to the bull market of the 1990s, and right on cue, Wall Street got back into the boosy nest of creating new stocks, cranking out nearly 5,000 IPOs. Then, after the bubble burst in 2000, only 88 IPOs were issued in 2001, the lowest annual total since 1979. In every case, the public has gotten burned on IPOs, has stayed away for at least 2 years, but has always returned for another scalding. For as long as stock markets have existed, investors have gone through this manic depressive cycle. In America's first great IPO boom, back in 1825, a man was said to have been squeezed to death in the stampede of speculators trying to buy shares in the new Bank of Southwark. The wealthiest buyers hired thugs to punch their way to the front of the line. Sure enough, by 1829, stocks had lost roughly 25% of their value. Here Graham is describing rights offerings in which investors who already own a stock are asked to pony up even more money to maintain the same proportional interest in the company. This form of financing, still widespread in Europe, has become rare in the United States, except among closed-end funds. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold and have only one result: price collapse. In many cases, the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that, at bottom, the public has a real aversion to the very kind of small issue that it bought so readily in its careless moments. Many of these issues fall proportionately as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesman will point to many such issues which have had good-sized market advances, including some that go up spectacularly the very day they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later when nobody wants them, and they can be had at a small fraction of their true worth. In the 1965 edition, we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before had so many new issues offered of such low quality and with such extreme price collapses as we should of knave investors. By the peak of the IPO boom in late 1999 and early 2000, however, Wall Street's biggest investment banks had jumped in with both feet. Venerable firms cast off their traditional prudence and behaved like drunken mud wrestlers, scrambling to foist ludicrously overvalued stocks on a desperately eager public. Graham's description of how the IPO process works is a classic that should be required reading in investment banking ethics classes if there are any. Experienced in 1960 to 1962, the ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon, bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962 and will let others make the next batch of quick profits in this area and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely the sale of stock of Aetna Maintenance Co. at $9 in November 1961. In typical fashion, the shares promptly advanced to $15. The next year, they fell to 2%, and in 1964 too. The later history of this company was on the extraordinary side and illustrates some of the strange metamorphoses that have taken place in American business, great and small, in recent years. The curious reader will find the older and newer history of this enterprise in Appendix 5. It is by no means difficult to provide even more harrowing examples taken from the more recent version of the same old story, which covered the years 1967 to 1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's Stock Guide. The shares were sold to the public at $14 in 1968, promptly advanced to $28, but in early 1971 were quoted at a dismal $25. Even this price represented a gross overvaluation of the enterprise, since it had just entered the bankruptcy court in a hopeless condition. There is so much to be learned and such important warnings to be gleaned from the story of this flotation that we have reserved it for detailed treatment below in Chapter 17.